see the charts on YouTube?
Yeah.
Yeah.
I think that will be, you'll become popular again. Hope. I actually get a bunch of the high school student also. We have a high school student, couple hundred, interesting sometime to listen.
Mm-hmm.
Okay, so I'm make them live on YouTube right now, so you can start.
Hi, everyone. We're going to look at the upcoming week, and then I have a whole bunch of charts to go through. Last week was very similar to the week before. The S&P lost a couple percent. The bigger declines were seen in the Nasdaq 100, and also in the bond market. Once again, commodities gained with WTI and CRB index up very nicely again. As far as the sectors are concerned, communication services was off couple percent. Financials were weak again. As I said, the tech stocks were weak again. So basically more of the same. We have a full slate of earnings. This might be one of the bigger earnings weeks. We have a bunch of banks, Bank One, Bank America, Schwab, JB Hunt, Travelers, Halliburton, Johnson Johnson, Netflix, Comerica, Lam Research, UAL, Procter & Gamble, Anthem Healthcare, Baker Hughes, Abbott Labs, CSX, that's a rail, SAM is the beer, Intuitive Surgical, Nucor, Steel, Danaher, Dow, chemical stock, or used to be, Philip Morris, PPG, Blackstone Financial, American Express, another financial, Schlumberger, an oil, Verizon, Newmont, certainly is a gold, and Cleveland Cliffs. As far as economic statistics, there's more Fed speak than anything this week. Monday, we have the Home Builders Index. Tuesday, we got housing starts, and we got Fed Presidents Evans and Kashkari speaking. Wednesday, we have existing home sales, and then we have Fed Presidents Daly, Evans, and Bostic speaking. And then at 2:00 on Wednesday, we have the Fed Beige Book, weekly initial claims on Thursday, leading economic indicators. And then Fed Presidents Bullard and Fed Chair Powell speak Thursday afternoon, and Friday we have the manufacturing PMI for April. So once again, like I said last week, should be a very interesting week because of all the Fed speak and all the companies that are reporting earnings. If we go start looking at the charts, this is a 60-minute, very short-term chart of the S&P 500 in a clear downtrend here, with nice downtrending channel. We stopped at a 38.2% retracement here. We bounced back, got that second hit for the trend line. Came back down towards the trend lines, kind of stopped at the 50%. And now it looks like we might go full blown and retrace 61.8% of the move since back in here. We also have the bottom of this trend line. So this area here, 4340 down to perhaps 4300, should be an interesting area. Maybe the market can hold in that area and start to go higher. We don't really want to retrace more than 61.8%, although the next one is like 78.2 or something like that. You can have really, really deep retracements, which turn people bearish and expect then that the lows will get taken out. But usually when you retrace 61.8%, you start heading back down towards the lows that we already put in, down to 4100 area. This is a 4-hour chart. Looks like a bull flag. All this flag is getting large here, so it might not be a flag. We broke this uptrend in momentum. Same down here with the 14 period RSI. So just the real mess, very sloppy conditions continue. This is a daily chart of the S&P 500. I have moving average crossover, very simple moving average crossover system on here. And it's just a 5-day EMA. It's the blue dotted line, which crossed and gave a sell signal right in here after a good buy signal down here. That remains bearish. Moving averages, as I've said, this green is the 50-day simple moving average. Moving averages aren't as important during very volatile sideways periods. They're much more important when you're in a definable uptrend or downtrend. But I do leave them on the charts. Support resistance obviously is this last high just above 4,600. And then you have 3 areas of potential chart support down here from this low, from these 2 lows and this low, 4,100, 4,200 area if the market decides to let loose on the downside. This is another daily of the S&P 500. Just showing you how sloppy the market is, not the greatest of trading environments, unless you're extremely nimble. We had the death cross. I've showed this before. Sometimes it precedes pretty nasty bear markets, but in most cases, it doesn't really have much weight. It just takes way too long to develop. And many times when you finally get the cross, which would have occurred down near this low, either half or 3/4 or most of the decline is over. But it has preceded major bear markets, a couple major bear markets in the past. We had a false breakout, which is negative. We had a false breakdown, which is usually positive. We did have a nice rally off of there, and now it feels like we're heading lower. We look at the Nasdaq, same kind of deal. Nasdaq, as I said, the S&P 500 had retraced 50%. That would be in here. The Nasdaq and the Qs are right at the 61.8% retracement of this move off the bottom to here. So they could let loose, and we could see, a test of the lows or lower lows. So the next interesting chart, I took everything off the chart. Sometimes it's good. You get too many indicators or moving averages, and you can't make heads or tails. That pun was intended. Of the charts. So sometimes I just take everything off and try to reevaluate, based on price alone. And it's possible that the Nasdaq is tracing out an inverse head and shoulders. We have the left shoulder here. We have a complex head here, multiple taps, and then we're in the right shoulder, possibly. Now the Nasdaq has come back pretty much to where the left shoulder is. So we really don't want to see much more on the downside, or you can throw this pattern away. If we take everything back off and look at the Nasdaq from a different perspective, we might have a diamond pattern. Diamond patterns are generally topping patterns. But I will say they can go either way. Your buy or sell signals come when, the Nasdaq were to break out of the diamond, to the downside or break it to the upside. That would be your signal either to go get more cautious or to get more bullish. These are not particularly common patterns, not particularly reliable patterns, but they do happen every so often. These are the Qs. As I said, the Qs and the Nasdaq, right at that, see the Nasdaq and the Qs right at that 61.8% retracement of the rally since the middle of March. A key area, as you can see, if this is a right shoulder, this is the left shoulder, we are right near the bottom of the left shoulder. So for two specific reasons, the chart pattern and the retracement level, we have two very important technical pieces of potential support that we don't want to lose here. So if we don't get a turnaround early next week or into next week, you know, here we go back to the lows, and we'll do more, probably do more testing of this very, very sloppy pattern. This is a look at market breadth on a couple different indices. Market breadth generally on the daily, if we look out a couple years, does not really look too bad. This top, or the second panel, this is the S&P 500. See, we broke trend a few months ago. This is the NYSE common stock only advanced decline line. You know, it's a very mild downtrend. We started the downtrend probably off of this point. We did make a higher high in price, but this is the S&P 500. And then it's been a slow grind down. So nothing serious. You're just in a downtrend with respect to the AD line. If we move to the lower panels, this is a AD line of the S&P 400 mid cap. This one here is a small cap 600 S&P, and this one here is an AD line of the S&P 500. So if you look at the AD line, we're in a nice uptrend. I mean, we've basically gone sideways. We did make our last high early this year, which was commensurate with the high in price. I think in January, it confirmed a high. But since back in the summer, we've basically gone sideways and haven't seen a whole lot of deterioration from this breadth measure. The small caps or like this look like the NYSE. They've been in a mild decline since the peak back here in the summer, and even the mid caps pretty much sideways. So not a whole lot of deterioration here in some of these AD lines.
Mark, could you just pause here? Can you explain to, with the term, what's the AD line?
Oh, I'm sorry. It's the advanced decline line. So let me go back to that chart. We keep a running total on each index of the number of stocks that go up and the number of stocks that go down each day. So if 2,000 stocks on the NYSE go up and 1,000 go down, that's a net 1,000. That net 1,000 or cumulative number gets added, and you keep that cumulative line going. And it's just it's the simplest of market breadth indicators. What you want, you at least want the AD lines to confirm price. So if price of a particular index is going to a new high, you'd want to see the AD line, like here, the S&P went to a new high, and the AD line for the S&P went to a new high. So that means that breadth is confirming that advance. Sometimes during this bull market, if we go back to 2009, the secular bull market, breadth actually led price, which was very bullish. Breadth, S&P might be in a sideways pattern, and breadth would break out to a new all-time high, and then a month later, the S&P would follow. On the flip side of that, the bearish side, or the bearish argument, would be if breadth started leading price to the downside. If the AD line, advanced decline line, started breaking lower before price, that wouldn't be good. Sometimes these AD lines have very long lead times. In fact, the AD line, I think, peaked in 1998, and the market never topped. The S&P never topped until late 2000, well after the AD line peaked. But other times it's, weeks and months of non-confirmation or deterioration before the actual index moves to the downside. This is the Nasdaq 100 on the top, price breakdown out of the channel. And this is the Nasdaq advanced decline line, pretty much the same. If you look at them, if you were to overlay them, we had a peak here, lower lows, lower highs. From the appearance of the 80 line of the Nasdaq 100, it does not look like it is leading to the downside. It is moving with price. So that's kind of a neutral stance. We can't really, it's not bearish. Let's put it that way. The worrisome part about market breadth is the makeup of where so many stocks in the S&P 500 are in relation to their 200-day moving average. On the top panel, this is the percentage of stocks in the S&P 500 that are now below their 200-day or longer-term moving averages, which means they're in longer-term downtrends, intermediate to longer-term downtrends. And you see we've had weakness since early 2021. So over a year, we've had deterioration in many stocks. We were up around 95%, I think, back in here. We fell below this key 45% level, rebounded very quickly, and now we're right at 48. In the past, when we have gotten and stayed below 45%, that has been trouble for the stock market. That is where many times you will see the majority of the decline for a correction or for a bear market. So we're right on the edge here.
So Mark, I like to just interrupt a little bit every time you go, so that first of all, the audience get used to and also understand. So my question asks you this S&P A200R, this downtrend, you kind of signal us that S&P, the whole US stock market's going downtrend this year, possibly? Is that
yes, this weakness in the average stock on the S&P 500, basically 50-50 here. We got 50% above, 50% of the stocks below, and you just don't want to get too many stocks in the S&P 500 in longer term downtrends, because that, honestly, that can precede bigger declines in the overall index. Now, if we look for a really scary picture, this is the Nasdaq 100 on the top, and down here, it's the percentage of stocks in the Nasdaq that are above their 200-day, just like the prior chart. And you can see we've got down to about 20% here. Of course, the Nasdaq and the Qs are in bear markets. So below 45% is the danger area. We're down around 33%. So 67% of the Nasdaq 100 are in intermediate to longer term downtrends. And we need this to start to improve. We need chart patterns to improve. And we need many stocks in the NDX to start to recover and get back above their longer term moving averages. Now, the reason I don't show you the Nasdaq advanced decline line, if you think about it, it's absolutely meaningless. And I've seen technicians throw charts up with the Nasdaq AD line. And what are there, 3,000 stocks in the Nasdaq? So you're weighting each one, the smallest one versus, Apple and Microsoft, they all get the same weighting in the AD line. What's kind of strange, though, is that the AD line for the Nasdaq has worked over time. But in my opinion, there's just too many. There's thousands of stocks in the Nasdaq that are just too small because their market weight is so small. There's too many of those kind of stocks that don't have anything to do with the performance of the overall index. So if anyone tells you, you be worried about the Nasdaq AD line, no, it's worthless. Okay, we're going to move to Bitcoin and Ethereum. Bitcoin had what looked like the start of a nice breakout. I turned bullish. I was wrong. What we saw was a false breakout, similar to the look of the indices. Some of the indices, S&P, made higher highs here than back in here. So they kind of had false breakouts ever since. Bitcoin has come back down. Sometimes when you have these false breakouts, you go all the way back down to the other end of the range, which is down 33, 34, 35,000. But definitely not what I was expecting. And a good reason right there why you have stop losses in anything. Ethereum, same thing. I don't have the trend line, but we broke out above this prior high here, and above these prior highs represented a false breakout. And we've been in a downtrend ever since. Ethereum does have some support coming in between 2,900 and 3,000. We're just below the 3,000 level right now. So if we don't hold this, then we could be back between 2,200 and 2,500 level, which were the three prior lows, one here, and one in here. So at this particular point, the Bitcoin stuff does not look very good from a chart perspective. Now we're going to move to a couple charts that look interesting. There's probably more stocks that look better from the downside than they look from the upside. But this is an interesting one, KBR Inc. This is not a recommendation. This is just an illustration. The stock back here went sideways, and this is a weekly chart. So this is going back to last summer. You can see during this sideways consolidation, it was pretty tight. We kept holding this green dotted line, the 21 week exponential. That's a very important, the 10 and 21 daily, weekly, monthly averages, I think, are used by many people and maybe algorithms. But anyway, every time we got down to this 21-week exponential moving average, KBR bounced back. We broke out here. And then during this uptrend, we found support right here intra-week from the 10-week EMA, and then intra-week again from the 21-week EMA. Got overbought. We pulled back, and look where we stopped, right at the 21 EMA once again. Then we had a huge breakout these 2 days. And if you look at these two vertical green lines I have, look, this is volume here. Look at the volume that went into the stock on those 2 weeks, and they're big white candles, big up candles, institutions coming into the stock, which is very, very bullish. We've kind of gone sideways, had a big move, overbought, and once again during intra-week last week, in a terrible market. So far, we found support at the 10 EMA, and this kind of looks like this little pattern here. Kind of looks like an ascending triangle that wants to break out. Down here, we have the stock versus the S&P 500 on a relative strength basis. So if this line is rising, that means KBR is outperforming the S&P 500. And if it's falling, it's underperforming. So you want stocks, the old William O'Neill way. You want stocks. You probably wouldn't be buying too many stocks in this market, but you want stocks breaking out or at new highs. You want to see volume confirm those new highs, and you want to see strong relative strength versus the major indices. This is everybody's favorite yoga stock. This is Lululemon. I love to find former market leaders that have gotten crushed. Last week, I talked about Home Depot and Target. Both were former market leaders. Home Depot didn't have such a great week. Target did have a pretty good week. But Lululemon, certainly a former market leader, very strong fundamentals, but it's just gotten crushed here from the high 400s down to the high 200s. This last 3 pushes down, 1, 2, 3, is called a 3 drives pattern. If it happens after a big decline, it can be a bearish pattern or formation. So you could consider this a false breakdown, and also this one too. We had the trend break. This is off the highs. We had a trend break, and then we had a huge gap up this day, which corresponds to this dotted green line, which also corresponds to this massive volume day. I probably should have looked up, but I'm almost positive that this was related to earnings. I might be wrong, but when earnings surprise, especially after stock gets killed, stocks tend to do well. And since that big breakout, the stock basically held most of its gains, went sideways back. This is the 10-day EMA, kind of bumped its head. This red line is the 200-day, bumped its head against the 200-day as it rested. And then last week, Thursday, we popped above the 200-day. So this is an interesting stock, I think, from the long side. It has just started to outperform the S&P 500. It's about the middle of March. I like to see longer term relative outperformance, but this is a good start, and certainly an interesting one because it had been a market leader for some time. This is Arch Coal. This has been one industry that has led this year, I guess parts of last year. We kind of, or everyone kind of wrote the coal industry off. Well, you still got a power of power plants, and I don't know the fundamentals of the coal industry. All I know is coal prices have gone way up. I do talk to a guy that runs a coal-fired plant out in the middle of Pennsylvania, and we were talking about how much prices have gone up. You can see stock had a nice run here, traced out a nice cup, and then the day before, 2 days before we broke out, had a big white candle here attached to this dotted vertical line, and look at the big volume spike on that day. And then we finally broke out and kind of rode the rails higher, getting support from the 10 EMA every time we pulled back, little bull flag here. Then we put in a little peak here, big volume during this whole advance. And as we're breaking out again, this looks like a pennant formation. This is a flag. Pennant and flag formations are continuation patterns, and you'll see them during many uptrends. That's probably or primarily the pattern that you want to see develop during a pause as the stock calms down and takes a rest and works off a momentum overbought condition. This is one I mentioned last week, is silver stock, wheat and precious metals, WPM. Looks like we're breaking out from an ascending triangle, had a pretty good week last week. During that, we had this big run up. During the pullback, what do we hold? The 21 day EMA, which is this green line here, here. So that's always a good sign. And we've had big volume in here, mainly on advancing days. That shows institutions are accumulating the stock. And then if we look at relative performance versus the S&P, you can see that since about December, we had a nice run up by the stock versus the 500. Things calmed down here for a bit, and it looks like we're rounding and starting to head higher again as far as relative performance is concerned. So a good look here in a sea of red. Oil stocks continue to do well. This is Murphy Oil. We had a breakout. Usually I like to look at flat tops, but this kind of had declining tops. We had a breakout here of this trend line, ran up a little, came back and tested the top of the line. So once resistance is now support. And then the stock has been, you could call them riding the rails higher between the 21 EMA and the 10 EMA. And look at all these days that we're just sitting right on the 21 day EMA, ran up, pulled back, same average. A lot of times these stocks will break out. When they do pull back, they'll pull back to the prior high. This is a great example here. This was the breakout level right here. And then we pulled back. When we pulled back, we pulled back to the breakout level here. Had another run higher. Now it looks like the stock, like the other one we were looking at, looks like this is a pennant formation, which is a continuation pattern of the prior trend. So to me, it looks like it could break back to the upside once again. If we look at relative strength down here, very nice relative performance for the versus the S&P 500. Going back to certainly the beginning of this year, very consistent outperformer. So another nice looking setup. If we look at, I always, when we're in a decline like this or an advance, I always try to look at the top stocks within a particular index. And the Q's, Nasdaq 100 is very heavily weighted towards 5 or 6 stocks: Apple, Microsoft, Amazon, Tesla, and Google. So I keep an eye on these biggest stocks, and they're also the bigger stocks in the S&P 500. So they make up a lot of weight in a lot of different indices. So it's very important for the bull case, these stocks are doing well. So if we go to Apple on a daily, I mean, it almost looks like, almost like the S&P 500, a little better because this move here got back closer to its high. Maybe a little better than Apple, but if we look at relative performance of Apple versus S&P going back to December, it's basically been flat. And that's not what you want to see from one of your leading stocks, one of your largest stocks in the world. And if you look at the pattern since this peak, I can't really read it. Maybe we had a false breakout here, false breakdown there. Very difficult stock. I mean, why in the world would you want to, trade something like this? If I can't see a pattern or tell you, there's better than 50% chance or probability, I think this stock is going to continue higher, continue lower. And I don't think many people can. And people, the veteran trader either plays the edges, the tops and bottoms, or it goes on to something else. There's no reason that you have to trade Apple. If you want to buy it longer term, that's fine. But you want to trade something like this is messy, as opposed to, something like this or something like this, which look how tight this move is, up, down, up, down, up, down, up, down. And then you go to Apple, it's all over the freaking place. So very, very difficult. I call it unreadable. Maybe somebody can read it, but I can't read it. Second largest stock in the NDX is Microsoft, also taking a hit. The chart, this bottoming, potential bottoming, looks like the Nasdaq charts, looks like the Q charts. I kind of doubt this is an inverse head and shoulders. You should not, during these shoulders here, left and right shoulder, this is the head, you shouldn't really retrace this much and get down near the head. So this one doesn't look very good to me. And if we look at relative strength versus the S&P 500 going back to about December, late November, we had this big down move sideways and then down again. So no reason to be, trying to trade something like this. Find the stuff that, looks readable and go with that. And same with Amazon, which is the third largest in the NDX. This is a weekly chart going all the way back to basically July of 2020. So we're approaching 2 years here of just slop. We had a false breakout, if you want to call it that, here. You pulled back into the range, you tried to break out again. Then you had a false breakdown below the support here, right in here. And we've tried to rally again and failed. And it's just, it's neutral at best, if I were to have to come up with a conclusion. And it's another one that, unless you're trading the edges, which is the highs and the lows of the range, something, I don't think people should be messing with over the short term, even intermediate term. Let it base, let it do something, let it tell you that it's going higher or it's going to go lower, and just sit back. You don't have to do anything. It's the advantage of being an individual investor. You don't have to have 100% or 90% of your money like a mutual fund does invested in stocks. How would you like to be a mutual fund manager sitting with this thing or sitting with Microsoft? What are you going to do? Sell one of them? What are you going to buy? So that's the tough business. Now, I will show you one sentiment indicator. It's not my favorite sentiment indicator. It does get a lot of market press. But these people sometimes can be right. And this is the American Association of Individual Investor poll that goes back, I might go back to the 80s. Sometimes this is the smart money and not the dumb money. It has been on occasion, but typically when bulls get down to 15, 16%, which I think is the lowest percentage of bulls in this poll, going back to 1992, it kind of raises your eyebrows. And if we look, I think the bearish sentiment is up in the mid to high 40s. So you got everyone leaning on one side of the fence, and when that happens, as I said before, the fence is going to break eventually. This down here is just the difference between bullish sentiment and bearish sentiment on the poll on a weekly basis. And we've gotten down to basically negative 33 percentage points, which is certainly the low of the last couple years. And this is an area, as it was over here, in the 30% plus area. Actually, we're below 30%, I think, here, or we were. But when you get down this far, with so few bulls and so many bears, generally that's a good sign, over the intermediate term, that the market is near a bottom and that you will see outsized returns moving forward. And that is it for the charts. Okay, let's look at some individual stocks. Tesla, one of the larger stocks, fourth largest in the NDX. Possibly this is a bull flag right here, which would be a continuation move of the prior move, which would be bullish. This kind of looks like an ABC reversal, ABC, but it should, it better turn soon or this flag gets too big. So somewhat, a tough chart to read because you got these prior highs over here, and a failure to make a new high here, but some outperformance versus the S&P 500. So not a bad look, but with the Qs and the Nasdaq underperforming, it's hard to make a case for many of these mega cap techs. the triple leveraged ETF TNA, which small cap bulls. This would be interesting. I don't recommend. Well, this is 3 times of what the small cap indice will do. So it's hepped up, it's leveraged. Maybe this is a base here. We've gone sideways. If we could take out this high, could be interesting. But right now, we're still in a downtrend. We got a potential base here, but really no sign, that it's early enough to start buying, unless we were to take out this prior high. Let's see, WSM. This Williams Sonoma. This was looking interesting. I looked at this recently. This looked like an inverse head and shoulders here. We got a shoulder, a head, shoulder, and the neckline. I don't like to draw diagonal neckline, so I'd put the neckline at the top, right there, about 167. So if it were to, break out over 168, get back above the 200-day, it could have, a very good move, possibly back towards the 200, 210 area based on the size of this inverse head and shoulders. Right now, there's nothing to say that this won't go to new lows. So it's a tough chart to play right now, unless we take out that neckline up here. I think somebody asked about Macy's. Not too bad, nice base, potentially building here, but another one, to really get a buy signal, you got to take out these tops around the 28 area. Who's to say that we don't make new lows? Let's move on. Semiconductors, oh boy, have not done well. This one in particular, this would have been an interesting short when it broke these lows here. Oversold, I would suspect. But this chart clearly looks bearish unless we can get above this breakout area in the low 100s. Then it's got some possibilities. And then if we took out a trend line here, off the peaks here, that's way up above there though. But the first buy would be to recapture these lows so we have a false breakdown. I guess the good thing about AMD is it was a pretty nasty week here and volume kind of dried up. You saw bigger volume back here, a little bigger volume down back here during these down moves. This down move, we're seeing a decline in volume, which sometimes can mean you're getting close to the end. So a possibility here is developing. United Healthcare, the HMOs, Anthem, United Healthcare, Anthem is AMTM, Humana, these other two look very good. New all-time highs, nice relative strength. So a couple of these HMOs are really acting well. Stocks, new low. You don't like to see stuff making new lows. And you did see these two, Friday, and I guess it was Wednesday here, you did see a pickup in volume. I don't know if that was due to one or a couple different stocks, but you know, you need to see some kind of turnaround. You certainly don't want to see volume pick up on the downside, and then relative performance wise, you can see that stocks have underperformed since early December. Let me just throw something on here real quick. Oops.
Mark, just remind you, we have 5 minutes. We need to leave some time for the questions. Every time, probably a few questions.
Okay, this is the RSI. Let me put the RSI on the top. This is a momentum indicator. We've kind of had a bullish momentum divergence here, and one possibly here. You have lower prices here, higher momentum, lower prices, higher momentum. So that's could be a sign of a potential turnaround. Another semi. We looked at this, so I was wrong on this. And some of my work I do, this was looking good. It broke out. Now back to not acting as bad as the other semiconductors. But you would want to see it hold these prior lows down here 206 or something. And you've seen some decent volume here on the downside. So certainly a group that institutions do not like, along with many other tech stocks. So why bother? The action's been stock-wise, you know, it's been in the commodity stocks, it's been in the oil stocks, the coal stocks, starting to see some gold and silver stocks acting well, fertilizer stocks. It certainly hasn't been, you know, in the form, you know, the prior leaders remain the biggest laggards at this point. Uranium stocks. Oh boy, where is that? Good question. There's another one that has worked. I have a symbol here. I thought URA. They've done very well. I guess I think this is an ETF, Global X Uranium. This is one I look at, and another one is URNM. Also an ETF. Uranium has, I'm assuming uranium prices has gone up. I'm pretty sure that's true. So these have been outperformers, commodity type. So this is the area, you know, you want to concentrate on. You want to concentrate on what groups, industries are working, and because that's where the money's going. Momentum follows those stocks that are going up, and there's no reason to be messing around with anything else right now. I think that's about it on the stocks. SQ Square. Trying to bottom, but another one, you know, relative performance, I'd like to see turn back up. Certainly a little better looking than the semis, but it's probably further off of its highs. But we do have higher high, higher lows. So a potential long, but you know, don't forget your stops. That's how we stay trading, how we stay in business. That's rule number 1, 2, and 3. Okie doke. think that's about it.
Okay. Thank you very much, Mark. And thank you, everyone. I just want to let everyone know that this is the third time, right? Mark, is this your third time?
I think it's the fourth.
Okay, it's actually fourth time. So I want to thank you very much for you spend time, and every time you're adding things. And also everybody know that AFI is provide all those knowledge for free, but we actually have to compensate our instructors' time and research. So if you feel in the last couple of times and this seminar is very helpful for you, please donate here. And this is the first time in this seminar I ask for donation. I usually don't. And we do need your support. First, not just supporting AFI, and also support Mark to continue to give us this kind of knowledgeable talk every Sunday. And even tonight is Easter. Mark still prepare very well. And then he checked me 1 hour ago, said, "Hey, Angeline, today is Easter. Am I still on?" I said, "Of course." So we will really appreciate 就是跟大家说，如果你们觉得这个在听 Mark 的这4次哈，不管你是第1次也好，第2次也好 ，Mark 这已经是第4次给我们 AFI 和思汇做的这个免费的这个讲座。那么我也说过，大家这个 Mark 自己是他的会员都是收费的，但是给我们 AFI 呢，我们是有给 Mark 一些付费哈，所以呢，我们也希望我们的平台的这个投资的这个 momentum， 因为我们 AFI 最早开始就是通过这个投资的这种知识的普及发起的那么现在做到青少年的这个金融的讲座。那么最近汤老师他这个已经改行了，也不叫改行啊，他现在进的新的公司对他的这个在对外面讲座有 restriction， 所以呢，我们也是请到了 Mark。所以呢，如果大家有一点感动，有一点学到知识哈，在过去的1年半里面，也欢迎给我们捐款。如果你过去捐款了，也希望你继续，因为我们的工作在继续，我们的公益也一直在继续，没有停下过。好的，那我也在这个聊天室里面放了我们的 donation 的链接，你们随时到 Alliance for Impact.org 他们也有 donation。那么我把时间看看可以 open to 一个 question，we open to one question。Okay. So Mark, can you read the chat room, or maybe I just picked a question? You know what? I think to anyone who too many questions on here. So I just want someone, if you have a question, can you just raise your hand? We will take 1 or 2 questions from the audience. 我们可以 take 1到2个问题哈，大家举手回答好吗？这个有 Cindy， OK， 好，你可以。Cindy， 你可以开麦，我应该允许你开麦的是吧？
好的，开了已经。对不起啊，我的那个 capital 的那个 letter 给刚才不小心弄起来，就是我应该用英文问。I missed the stock symbol for the coal stock. Could you repeat what the stock symbol is for the coal stock you talked about?
Yeah, ARCH, ARCH.
ARCH. Okay, thank you so very much.
You're welcome.
Okay, anybody else have a question? Anyone else has a question? So we all, with Mark, we want to be on time, finish too. So we start a few minutes late, so we're gonna end it right now. Thank you, everyone, and happy Easter, Mark. I know you're non-religious, but happy weekend. And I will see you next week, okay?
Okay.